Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PETROCHINA Company Limited quarterly report. PETROCHINA Company Limited offers a diverse range of businesses and services across various segments. At its core, the company engages in petroleum-related activities such as exploration, development, transportation, production, and marketing of crude oil and natural gas. This includes involvement in new energy resources like coalbed methane and oil sands. The refining, chemicals, and new materials segment is another significant aspect of PetroChina's operations. Here, the company refines crude oil and petroleum products, producing primary petrochemical products, derivative chemical products, and other chemicals. Additionally, it engages in new materials business and invests in refining projects. PetroChina also operates through its sales segment, which involves marketing refined and non-oil products as well as trading businesses. Furthermore, the company is involved in natural gas transmission and sales through its natural gas sales segment. In terms of infrastructure development, PetroChina provides technology transfer and technical services, develops chemical technologies, and invests in storage facilities, service stations, transportation facilities, and related businesses. The company also trades crude oil and petrochemical products, making it a comprehensive player in the petroleum industry. PetroChina Company Limited market capitalization of $2,202 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that PetroChina Company Limited holds a significant advantage in their industry. PetroChina Company Limited trades at a lower price-to-earnings ratio of 12 times and a higher price-to-book ratio of 1.21 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The company maintains a moderate leverage profile, with liabilities making up 36% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 4.32%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company can be attributed to several key factors. On the growth side, an increase in sales volume of domestic refined oil products, particularly gasoline, has contributed significantly to revenue growth. Additionally, international trading operations have seen an uptick in margins, further boosting revenue. Another crucial factor driving revenue growth is the increase in output of key chemical products such as ethylene, synthetic resin, and synthetic fiber raw materials and polymers. These products have witnessed substantial year-over-year growth rates, ranging from 16.7% to 21.4%. Furthermore, natural gas sales volume has also seen a notable increase of 6.9% YoY. On the other hand, revenue decline can be attributed to several factors. The decline in oil and gas sales prices has had a negative impact on revenue. Moreover, crude oil output has decreased by 1%, while overseas crude oil output has dropped by 5.6%. Additionally, oil and natural gas equivalent output has declined by 4.2% overseas, contributing to the overall revenue decline. The company's financial performance indicates a strong ability to generate cash flow from its operations. According to the provided information, the company has consistently produced positive operating cash flow in both 2025 and 2026. This is evident from the net increase in cash and cash equivalents, which shows an increase of $16,432 in 2026 compared to $87,517 in 2025. Furthermore, the financial statements reveal that both years have experienced positive net cash flows from operating activities. This suggests that the company's operations are generating sufficient cash to cover its expenses and investments. The operating cash flow is also reported as positive, which reinforces the notion that the company is successfully managing its cash inflows and outflows. Overall, these indicators suggest that the company is indeed generating positive operating cash flow, demonstrating a healthy financial position and ability to sustain its operations. The company's debt levels have experienced significant changes over the past year. Total liabilities increased by $170,097 from $1,032,684 in 2025 to $1,202,781 in 2026. This growth is largely driven by an increase in short-term borrowings, which rose by 51.1% from $64,103 to $96,812. While long-term borrowings also saw a modest increase of 6.2%, the overall debt level has expanded. In contrast, interest expenses have decreased substantially. According to one report, interest expenses dropped by 25% from RMB 3,577 million to RMB 2,942 million. Another source indicates that this decrease is even more pronounced, with a reduction of RMB 299 million from RMB 4,548 million to RMB 4,249 million. Furthermore, the company paid out 15% less in interest, decreasing from RMB 52.54 to RMB 44.70. These reductions suggest that the company is either paying off debt or benefiting from lower interest rates. The recent financial reports have highlighted areas of concern within certain regions and segments. Notably, Xinjiang Oilfield Gas Storage Co., Limited, has shown a decline in its operating activities, with net cash flows from operating activities decreasing by 43,609 million RMB. Additionally, the company's investing activities have seen an increase in net cash flows used for investing activities, amounting to 15,968 million RMB. This poor performance is a cause for concern and warrants further investigation into the underlying factors contributing to these declines. In contrast, there are no explicit mentions of regions or segments that have performed well in the summaries provided. The lack of detailed information on each region's performance makes it difficult to assess their overall standing. The company's management has expressed a positive outlook on its adaptability to the evolving international oil and gas market. This indicates that despite the challenges posed by changes in the market, the company has successfully adjusted its strategies to remain competitive. The management's confidence in the company's ability to navigate these changes suggests a proactive approach to managing risk and seizing opportunities. The company's financial records clearly indicate its commitment to rewarding shareholders through dividend payments. According to page 22 of the report, it is explicitly stated that dividends paid. Yes, with specific amounts provided for both controlling and non-controlling interests. Furthermore, page 18 mentions cash payments made for the distribution of dividends or profits, solidifying the company's history of making dividend payments. This demonstrates a clear policy of returning value to shareholders through regular dividend distributions. There are concerns about inventory buildup and supply chain disruption. One of the main reasons for this concern is the decrease in output of certain products, such as urea and gasoline, which may lead to an increase in inventory levels. The cash flow statement also indicates potential inventory buildup. The company has been paying more cash for goods and services than it has received from sales, suggesting that inventory levels are increasing. This could be a sign of inefficient supply chain management or overproduction. However, there is also evidence to suggest that the company may be experiencing supply chain disruptions. The decrease in cash paid for goods and services could indicate a reduction in inventory levels due to reduced production or supply chain issues. That concludes the financial summary for PETROCHINA Company Limited. Feel free to comment below, and I will be happy to answer them when possible.